All right, a very warm welcome to you wherever you're joining us from. Welcome to My Chat with the Bank CEO. This is part of a series of conversations that we are exploring different topics from a financial and banking perspective. We have been bringing this series to you for the last couple of weeks, and today we continue with that conversation. We're live on YouTube, and that's where you can stream this conversation and follow the chat there. You can remember to share your comments and questions on the same platform. At Kenya Bankers is the handle to follow. It's where you can also post your questions. At Jim Cario is where you can find me. My name is Jimmy Mbogo, and I'm your captain for this conversation today, and I'm in the great company of Mr. George Odhiambo, the Managing Director, National Bank of Kenya. George, how are you feeling this morning?
Pleasure. I'm feeling nice, Jimmy.
Wonderful.
Good to have you.
And great to have you as well. Mr. George Odhiambo is a seasoned banker. He previously served as the MD of BPR Bank in Rwanda, following the merger that is between KCB Bank Rwanda and BPR. He also served as the Managing Director, KCB Bank Rwanda. And just to give you a bit of his background in the financial sector. And today's conversation, the topic that we are looking at is innovative financing solution for MSMEs and opportunities and challenges therein. We know that in the market that we operate in here, particularly here in Kenya, the MSME players are becoming quite a critical part and an integral part of our economy. They create over 80% of the jobs that we see in the country. We'll be getting into that conversation in just a couple of minutes. But George, the floor is yours. I want you to make your opening remarks, and then we'll pick up the conversation from there in terms of what next for SMEs. Where do we go? What are some of the issues that SMEs are dealing with, and what are the solutions that we can have?
Yeah, thank you so much, Jimmy, for that opening remark and the kind introduction. I didn't know it has been that long a journey for me to be here. So every time that we talk about financing and innovative financing, for that matter, in the banking sector, SMEs become a big challenge.
Yeah.
And that challenge for SMEs is not something impossible to scale. It is because of how we understand it differently, different players, different perspectives. And the regulation also expects banks to behave in a certain way. Mm-hmm. And the expectation to behave in a certain way forces the banks also to think of business people differently. And there's several categories of SMEs.
Yeah.
Some of the customers that we serve for many years do get to realize they are categorized as MSMEs long after we've been dealing with them, and they don't understand what we are looking at in them.
Yeah.
And my perspective over the many years is that they need to be more conversation, need to be more collaboration, need to be more awareness. Mm-hmm. When customers come to open an account, the officer in charge or in front in the banking hall do take details. And at the point of account type, they many times write the account type, and for this matter, MSME. The person in front of them do not even know what they've written there. And that tag will be with you for many years as you bank with us. Mm-hmm. When you seek solutions and services from us, that will be the reference point. Who are we talking to? We are talking to an MSME person. Yeah. And without knowing necessarily where they belong, they are not prepared many times, and they miss opportunities for collaboration, for capacity building, for development in various ways. Okay. They just know they are traders. You ask them, what do you do? I'm a trader. I'm a business person. Yeah. But they don't know which part of the business they are categorized.
And I think that's a great place to start it, George. In terms of just defining who is a player within the MSME space and who is an SME.
The MSME, if just says in full, the context is micro, small, and medium enterprises. Yeah. And these are categorized in terms of the number of employees they have and the turnover. Mm-hmm. Just to speak about SME, part of the medium size part of it. These people would generally hire seasonally, but on average they retain not more than 100 number of staff. Mm-hmm. So the medium size would be 51 to 100. Yeah. The smaller will be 10 to 50, and the micro will be less than 10. That's on average. Yeah. Does not stop them from seasonally hiring more, especially depending on the sector they belong to. Mm-hmm. If they agree in processing, during harvesting, during certain activities, they will have more employees. Yeah. But the hardware type of a business person will consistently keep the number of employees. But when we have big orders, you require more loaders, you have more casual workers. So we really don't have those in the assessment. Yeah. We keep the average number for the year. Okay, so that's how we look at them. Turnover, number of employees becomes primary.
And you've actually just touched on my next question, which is in terms of the turnover, how much should they be doing annually or quarterly?
Every institution that assesses them for services have their own range, but on average you'll find that we'll be looking at between 500,000 to 10 million. And even the medium-sized one goes up to 100 million. And you'd find some customers or some businesses will go beyond what we categorize as a SME, but they will resist breaking the ceiling to go to the next level, because they're used to that person who serves them, they're used to specific kind of questions. So even if you try to upgrade them to the next small corporate, they default back to SME. That's why they're comfortable. So they're not people who really go out for aggressive growth or expansion. They love stability, which is difficult to attain. Many of them go to stability after 10, 20 years. So when you're telling them now at this point, you need to change your governing, you need to have a board, you need to have independent directors, so they find it uncomfortable to go to the next level. So that is a question also of awareness, what the next level could bring in terms of innovative solutions and lending. Because at that point, they don't need just debt only. They would be able to know that I can sell equity, I can raise funds. I can also partner with some value chain suppliers in my business and get credit in terms of material.
All right, and definitely we'll be looking at the different models of financing for these for players in these categories. But George, I know you bring a vast of experience from the region, not just here in Kenya. You've worked in Rwanda, and again, one of the a very solid market that when you look at the East Africa region. But the question that I want you to help us understand, when you look at SMEs of the early 2000s and SMEs of now 2025, I'm sure the needs of these different businesses have changed. And how are banks then adapting and preparing solutions that fit into the needs of today and not just coming up with a blanket solution that maybe worked in the 2000s?
A very good question. In the early 2000s, or say 2 decades ago, banks will assess SMEs and put a lot of premium on location. So if you're saying you're doing business in Nakuru and you're producing for Nakuru area or processing for Nakuru area or importing to trade in that area, we look at the market space of that area. And that has since changed because of technology. You could still be stationed in Nakuru but deliver to someone in Njoro, deliver to someone in Naivasha, deliver to someone in Limuru. So that miss of moving at the same speed of technology capabilities sometimes limit how we assess. And that's why you'll find someone saying, we can't support this financing to this extent in this area because the market is small. You could be operating in a very remote area, but your market is not there. Your market is elsewhere. And you find now banks and institutions of finance did locate certain personnel in certain areas because of that kind of view. This is the market we are addressing. That's no longer the issue. I do shopping from this kind of SMEs people when I want something, and I don't even know where they're located. I just go online and buy what I want. As long as they commit, they deliver it in one day, and I'm happy with that, I do that. So the market space is no longer a barrier to assessment. The second one is data capture. In early 2000s, it was very manual. It would take you many weeks to assess an SME and then be confident. Because lending is about building trust. I must trust that if I expose myself to you, you will come good and pay. It's about trust. So with technology, again, advancement, there are tools that we can use to follow your business activities, your payment methods. And we could simply not just judge you on your bank account only. A number of these guys are doing a lot of payments on a mobile telephone platform. And if you miss to accommodate that one, you miss who they actually are. Their receivables sometimes don't go to the account directly. But what we encourage them, in as much as it's come to the phone, channel it to that primary bank account so that your history is converged and built in a way that can be tracked by anybody willing to take a risk on you.
All right, now the thing that we have seen over the last couple of years is the fact that SMEs are categorized as high-risk clients, and particularly when it comes to them being able to access credit and access financing. But today, like you say, banks have so many options in terms of just looking at the credit history and the credit performance of these customers. So how do we change that narrative of perceiving SMEs as high-risk clients and into borrowers that actually need this credit and they're good clients?
There are 3 aspects of looking at that high risk you're talking about. When SMEs open accounts and place deposits with banks, nobody really questions them as expensive or high risk. When we look at compliance, SMEs then become risk in terms of enhanced KYC, anti-money laundering and CFT.
Yeah.
That becomes another perspective. And I believe you are referring to lending to them. Anything that you don't know, you heightened your risk awareness. If you're placed in a location in darkness and you're told to take a walk, because you don't see, you're not aware, any move you make is risky. So you're better off standing where you are and ask for help. And because we've not understood SMEs for long, and they've also not understood what banks are looking for, so we've looked at each other as risky partners. And that by default has made them look at banks not as the first priority when they need funding. They first look to friends, then look to family, then look to maybe cooperatives, before they come look at banks as the fourth option, sometimes the fifth option. So we are not their first primary option for financing. And even if they come to us and we finance them, we know they've tried other methods. So that divide is narrowing, because we are beginning to understand each other better. We are beginning to collaborate. Financial institutions are beginning to talk together. Kenya Bank Association is bringing us together. The government is getting interested in guarantee schemes, and other private partners are also coming to offer that kind of bridging. So it's a matter of risk mitigation. If I'm to share risk with you on certain aspects, I'll be more comfortable moving faster. If I'm to do it alone, I'll take longer time trying to look at it in every corner. The problem is I may be taking so much analyzing the risk, but I'm analyzing the wrong data. So I still don't get it right. Even if I give it to you because I'm convinced with my wrong data that I analyzed, you still see the non-performing loan ratio high. You ask, what were they analyzing?
And speaking about the role of government, and particularly over the last couple of years, one of the other things that we have seen is the number of credit guarantee schemes have increased, and we see this narrative being pushed, particularly even from the government side of things. And I want to know, from where you sit as a financial institution, does this make it lighter? Does this reduce the risk for you to lend to SMEs, or it is of no significance?
Theoretically, it's supposed to be lighter risk. Practically, it's supposed to be lighter risk in both ways. The challenge is awareness. And you see, a guarantee scheme is not owned by someone away from the person using it. It's a shareholding scheme. For example, if an institution or finance is a member of a credit guarantee scheme, they are practically a shareholder, meaning that any risk we take in the pool, we share with the people who took it and who did not take it. If you want to take a guarantee scheme where you're not a shareholder, for example, there's a premium you pay. There's a fee you pay for it. And this basically is a slow journey. Is starting to take shape. Trust elements were there before, and institutions perceived this from experiences elsewhere. Where this has been tried elsewhere in Africa, first of all, if customers pick that government was a shareholder, there's a perception that government was giving a grant. So if there's a percentage, for example, where served elsewhere in another country, government was guaranteeing up to 50% through a body established to do that. And customers would then at times pay up to that limit, and then assume they have finished paying because the other part was for the government to pay. So they didn't understand that I'm still borrowing, I'm still responsible. The government is simply giving me a guarantee offer because of my limitation of collateral and my need that is bigger than what I can actually take. But the government, because of the policy of growing the segment to create employment and for other reasons, did come through for them. But that has since changed. Since changed.
So do you think with these schemes then, it distorts the financial market, particularly the credit market? Because if you say, for instance, if we have customers who are borrowing and not fully repaying, then the risk for banks increases.
The distortion is a necessary evil. It's in the initial stages. Because once that awareness starts becoming practical in terms of those defaults, the banks still have contracts to make recoveries. At that point, people slow down and say this guarantee is causing problem, so people don't want to take it. But the moment you continue educating people and some people go through it, what you create is a larger pool that you've never have had of borrowers. And this larger pool provides you with more data. So over time, the number of people who are borrowing and paying become more and more and dilute the few that don't pay for reasons they didn't understand better what they got into, or someone was just mischievous. So in the longer term, it's a good thing to have these guarantee schemes, because the risk sharing is something that is sustainable, is practical, and encourages everybody who invests to expose themselves to such kind of services.
All right, so when you look at the credit behavior for SMEs within the Kenyan market and SMEs in other jurisdictions within the region, how do you think we are faring, and why is it that Kenyan SMEs and Kenyan businesses are always complaining that we are not able to access capital and to access credit from the financial market?
It is a conventional rigidity, because for a long time businesses in that category believe that capital is by debt. It's not supposed to be by debt only. It could be by other methods. This urge to own it myself brings that tension. You could be having someone with a very good idea with no money. Someone has money and has no good idea. If these two people team together and they only need to assure each other that they'll govern each other respectfully through a verifiable way and also ways that can be sustained, they'll put in money together. That's why people go buy shares in the security exchange or stock exchange. They don't even know who the owners before them were. They don't even care who the directors sometimes are. But many of them buy because they believe in the sanity and the governance of that institution. If our SMEs at the small scale could build that kind of comfort, there are people who would want to put money in various things they are interested in without necessarily sitting in that business. But today, if someone puts money in another person's business, what do they want? A desk in the same office, because you want to sit nearby. That shows that you don't really trust, if I'm away, these things will run the way it is. And for many reasons, if you call meetings or call workshops for capacity building, what happens? Half of the time they send people they employ who they don't need at that day. You go and represent us. But the real target was the person who has not come. So it is work in progress.
Okay, which brings me to another concept, which is when you look at our belief, again, particularly for those who are running businesses, it's I need money from friends, I need money from the bank as the last resort, or from even digital lenders to run my business. The concept of taking equity or seeding some equity and having an investor come on board is still not, hasn't picked up within the Kenyan market. So how do we change this, and why is it important for SMEs to say that, okay, George, I can see that you want to come in as an investor, I will give you 10% stake in my business?
That is a micro level manifestation of the problem. The bigger solution lies in the global contracting capacity. We need partnership contracts that are developed at a certain high level that people can trust. And these tools are available online. These tools are available in the law firms, but we need the voice of the partners in these guarantee schemes to say, here is an alternative. Here is a contract you can read through and can involve someone else who shares your vision and mission and can put money into your business. So the contracting part is the missing link. What guarantee do I have that if I put money in the business that you opened, you will involve me adequately to be feeling secure? Many times people say, can we change the name? You don't need to change the name. You just need to add a director and then have a proper contract, what the director's responsibilities and what they can do, what they cannot do. And also have a mechanism of how do people exit. But you find good businesses, good brands going down because the founders are not available. As opposed to you just adding a director. And very good examples are in law firms that are doing very well. You'll find law firms with names that originally picked from the founders' names, and those founders are no longer there. But there are new partners who run the same law firms, and they operate very well.
All right, and one of the things that we are part of this conversation today is we're looking at innovative solutions, and we live in an era where technology is central to our day-to-day living. So how then can SMEs leverage technology to, or even financial institutions, how do you leverage technology to come up with solutions that address the issues of the SMEs of today?
It is both ways. Financial institutions have leveraged technology to a great extent. What they're looking for is the data. And this data source is the businesses they support. So the SME side should start now keeping proper data, keeping proper records. And these records may not necessarily just be financials. They could even be some activities, a series of them, business plans, So that is where the foundation of the data that the financial institution analyzes comes from. So it doesn't really help to have a good instrument or a tool to analyze the risk or assess the need if the source data is missing. So leveraging technology starts with us as institutions of financial services educating, cooperating with the people who also do that, development partners, government, associations, business groupings, so that everybody starts understanding that keeping data may not necessarily look fancy now, but is what will make me look fancy to someone who wants to take a risk on me. However, the problem of that, it requires investment. If you invest on data captured a small business, possibly require a computer or a laptop and someone who is able to input data, who is able to make sense of it, able to back it up, able to protect it from viruses attack, able to protect it from cyber security. So it is investment that doesn't look like it's giving you a return, but that's investment we require. And how can businesses then do it if it's that damn expensive for the small scale? Let them pull together, let them share a data center. So these SMEs forming an association in a particular town or city could have some data centers that they share, and they can share resources, so they don't have to invest individually. So that is one way of takeoff that has been tested elsewhere.
All right, and just to remind you who is following this conversation that you can be part of this conversation simply by sending in your questions on X, on our where we are streaming this conversation, that is on YouTube, and also on our LinkedIn platform at Kenya Bankers, at Jim Cario is where you can send in all those questions, and we will be fielding them to Mr. George here, and he will be responding to your questions, each and every one that we get as we go along with this conversation. Now, George, there seems to be a gap when you look at what we in terms of the different categories of funds where SMEs can tap into. When you look at banks, when you look at investors, when you look at development partners, there seems to be a gap between these three where each is working individually in a silo. You have the financial sector players who are working in their own area. You have, let's say, venture capitalists who are also working in their own corner. So how then do we bring all these funds and make sure that SMEs have a bigger pool to be able to access credit?
The starting point is to create a common interest. Why all those funds go different ways, they pursue different interests. And some of them do not pursue different interests because that's the choice they've made entirely. Is the regulatory environment that you operate in requires you to comply in a certain way with how you operate. So for example, a venture capitalist might want to lend to a startup, and then you find a financial institutions like a bank will be hesitant to lend to a startup unless there are some other stringent conditions met. You find another funder might be patient, might be doing testing. If it fails, well and good, we'll move on. If it works, we'll celebrate. You find that the banks, for example, have got very limited window of accommodating failure, because the funding that we offer is not a bank's money pooled somewhere. It is another customer's money that we give you to another customer. And that other customer's money we are using is carrying a checkbook written pay by order. So they cannot come for it and we say, come another day because we lent it so and so. We must find it. On that framework, regulation then controls how you operate. You must have liquidity available to serve those kind of needs of in and out. You must also have a base that you can lend out and wait for some time. You also have to match your liquidity with the kind of exposure you're taking for a longer term. When you go to a venture capitalist, for example, many of them are people who actually are adventurous. It is because they do not have the serious urgency. They are people who want to make impact. They don't necessarily do it to make profit, but certainly they don't want to make a loss. And if they get a surplus, they extend their reach to other people. So is the interests are not convergent. We need to have a converging space that is already there to fund people who want to do businesses to create changes in where they live. But that intersection is still so small. That's why we get it differently.
Okay, so George, the big conversation today within the banking sector, and especially here in Kenya, is the conversation around risk-based lending. And I want to know, going forward, how is this likely to shape the access to credit for SMEs?
The risk-based lending is a good idea, and I think it's something that banks are working strongly with the Kenya Bankers Association and also working with the regulator to make happen. It requires certain investments because it's supposed to reward good borrowers and supposed to be cautious about those who are not so good. And the risk-based lending requires differentiation over time. If you don't have the right data, even the good borrower might be lost in the wrong borrowing bracket.
Yeah.
So we'll not get it perfect immediately, but we're beginning to see a sense of categorization of the customers, because the moment you're able to grade a client properly,
yeah,
that affects how you price them going forward. And the grading system is uniform for all institutions that participate in this. So the grading again depends on inputs that we have from our data that we get from customers. Let me give you one example of governance. If you are to rate governance and you are to deal with SMEs, they score low, many of them, because they operate without boards, and then they operate without succession plan sometime.
Yeah.
And then the hiring criteria includes not necessarily competence, kinship. So by governance, SMEs start scoring low.
Yeah.
If I increase the weight of governance in assessing them, many of them will fail. I cannot put them the rate of assessing governance the way I would do to a big corporation. They will fail. But if then I want to assess them in terms of their commitment to the business they do, I'll check out their business plan.
Yeah.
Many of them have short-term business sketch. They don't have a comprehensive plan. So they must start developing those plans. So when I'm grading them on their plan, on their governance, on their other financial aspects,
yeah,
then they can score high. Because the better score, the better the risk-based pricing. The key word here is risk.
Yeah.
If you don't get higher scores there, your risk is elevated.
Okay, and that's a great point that you mentioned there. So let me take you back a couple of steps, and this is something that you had touched on, and it is the reliance on collateral for financial institutions. So how do we innovate beyond just collateral, where we tell you bring your logbook, bring your title deed? How do we innovate beyond that and ensure that we provide credit for SME players?
We are trapped in a situation that we need not be trapped in. Collateral lending is not what financial institutions advocate for, but because it's the most tangible thing in the process. When you've assessed the customers' inflows, you've assessed their payables, you've assessed their payment patterns, all that.
Yeah.
That is soft to them as you're assessing that, because you're simply asking for a statement. They don't know what you're checking the statement. You're simply asking for their records and contracts. They don't know what you're checking. But the loud thing that pops up, they've asked me for a title deed. So it becomes as the key thing you're looking at. Whereas it's not necessarily the key thing you're looking at. So what happens next when this customer talks to another one who is needing lending? Don't dare go if you don't have a collateral. So many people haven't come to banks because of collateral, whereas that should not have stopped them. There are alternatives. And right now, I like what the customers in SME space are doing. They are adopting new alternatives of getting letters of credit, guarantees, import instruments, export instruments. So money doesn't really have to move, but there's a commitment that when this money moves, this will happen. For example, you have a contract and you don't have money to start that contract.
Yeah.
And you're doing it for a credible institution. Say you're doing it for the government of Kenya. And you're asking the department that is giving you the job to advance you 10, 20%.
Yeah.
They will not say no. They just tell you bring advance payment guarantee. Get it from a reputable bank. And every bank that is registered and being regulated by CBK is considered reputable.
Yeah.
So if your bank gives you advance payment guarantee, that instrument, that document gives you the opening for funding. So your next funding phase is on certificate of performance, meaning that you do not need it again and again. So every time you raise a certificate, is verified and certified by the engineer or architect or anybody supervising it, you get that. So many of them are starting those businesses, and we're seeing them unlocking their cash flows, they're unlocking their capabilities. Those who are doing 10 million projects are now doing 50 million, some are going 200, and they're doing amazing job in the short space. However, the risk is that when SMEs start seeing big openings, they become extra ambitious. They start 2 other lines of business.
Is that a risk?
So if you don't have the capacity and skills, is a risk.
Yeah.
You only better start it when you have the capacity. You can't be a contractor today and tomorrow you are running the largest supermarket in town, yet you don't have presence or management or skills on doing it. So do what you have skills that can be sustainable. So that's the issue we're dealing with sometimes.
All right, so George, let me move this conversation forward and let's talk about structural barriers that are limiting SMEs from maybe accessing things like blended finance and what they need to do then going forward to open up that area.
Structural finance that are hindering that kind of blended lending is an issue that we live with. And institutions have picked the solutions that are sector-based.
Yeah.
You'll find banks are focusing on women in business, banks are focusing on youth, banks are focusing on different kind of people, because all of them have different challenges. The way the family setup in this Africa is, especially in Kenya, a big proportion of women don't have right to property, but they have the right to use the property. You will till land that is not yours for life, but you cannot use the title deed anywhere.
Yeah.
You milk a cow that is not yours, but you take the milk, you have the right, but you can't sell the cow. Mm-hmm. So there are all those kind of recognition that are putting it in a way that you can still access finance without necessarily owning that. Yeah. Young people are coming to ask for money to do horticulture, do agribusiness, small scale, high value. They like short-term, high value production, but they don't even own the land. So they can lease that land. They can use that institutional land that is not being used. A creative one, recent years, small youth group came to me that they want to do horticulture, they want to plant vegetables and sell. Yeah. And the credit analyst or the officer in the front of the bank asked them where their land is. And that was a stopper because they didn't have the land. Mm-hmm. Their plan was to lease sections of secondary schools' land that are not being used, to plant there and sell to the school as the first customer. So no one gave them a chance to say how they're going to plant it. The issue was, do you have land? Mm-hmm. Then their mind registered collateral, and then they don't even have where to produce. So innovation does not just come from the banks, it also comes from the customers. And the best way to get that innovation is when we have meetings, we have workshops, we have networking events that people share their experiences. And sometimes the experiences people have gone through to get funding is what sometimes get elevated to be structured in a way that banks can adopt it. This issue of trying to get credit guarantee did not start with the banks itself. Yeah. It was Jimmy wants money from Catherine, and Catherine does not know Jimmy, but Catherine asked George, do you know Jimmy well? I say, I know Jimmy well. So based on that kind of trust, she gives you the advance. Yeah. And that is now they get formalized in a structure that becomes Africa Guarantee Fund, they become
other schemes,
mm-hmm. Credit guarantee schemes, because they originated from individuals trying to test those kind of methods.
Okay.
And for just to extend it a bit, so the more people that you recommend that come good to pay, the more trusted with other people. So if the people you recommend don't pay, nobody expects you to recommend anybody else that can get payment.
Okay.
And that's what you see the circle system. The guarantors, the recommenders, all those kind of things.
Yeah. Now, and just in a couple of minutes, we will be talking about in terms of just value chain financing and how SMEs can tap into that. But I want to switch gears and go to our online audience, and we have Kendrick who's asking, ask George how banks should leverage data-driven insights and innovative financing models to scale MSME lending while balancing risk and affordability in the current economic environment.
Mm-hmm. I believe the current economic environment is referring is in Kenya here. Yeah. And leveraging data, first of all, you need to get the right data. It's not just the data that is not making sense. And that data must not just be able to help you make a decision. That data must be able to help you make prediction. So your analytics should move from decision analytics only to predictive. Because what worked in the past 2, 3, 4 years might be distorted data. And then how do you use the distortion to make prediction? Let me give you an example. If you're using data in the east coast of Africa, so from Swaziland to Somalia, to make prediction for funding agriculture, and you take it from 1950 to the year 2010, flood risk will not be there. But what happened a few years ago? The east coast of Africa, in Mozambique, in Tanzania, flood destroyed large swaths of farmland. So that data should also be used by caution. Check one-off events that have happened. If you are using data in Kenya for you to make decisions in agricultural space, hurricanes will not be a point to talk about. But no one says that they'll never happen in future someday.
Yeah.
Climate is changing. The climate risk is evolving. So things that we don't see here might happen. Mm-hmm. So in terms of trade routes also, you would never imagine when we are funding people to get our imported material or goods from Southeast Asia or from Middle East that will have Indian Ocean barrier cost of insurance. What happened 20, 25 years ago? There was a group that took control of that trade route, and you could not pass there. So just a few years ago, when you are transporting certain goods from other places in Asia, Suez Canal was the only option, guaranteed. It's never guaranteed because you don't know when the peace talk somewhere will fail, and for 10 days, it will not be an option. So leveraging data must stay sensitive to new developments that happen. Okay. Data must help you make decisions, but also help you make prediction. That's when it supports credit, because credit is a risk you're taking in the future. It's not a risk you are assessing in the past. Okay. Now we also have Amy Wahome, who's asking, how do you ensure that digital transition does not exclude low literacy or rural customers from a more inclusive banking system? Unfortunately, that intention is good, but is not very practical because it invests in individual investment. If you are not going to exclude digital or rural economy, you must provide electricity infrastructure that people must be able to charge those phones or gadgets. And the reason that those smartphones don't sell so well in those areas is because they don't retain charge for too long. You have a smartphone, possibly charge it 2 or 3 times if you are a heavy user in a day. But you have a feature phone, you charge it twice a week, even if you are a heavy user. The second thing is that the owner of that gadget must invest in it. That is one limitation. The competition of what you want to spend on in an economy where people have so many demands. Do I buy school uniform or do I replace my phone? That's a decision someone has to live with. And those kind of limitations sometimes stop us from including everybody at the same time. What I would advocate for is a tax regime of acquiring those gadgets. If you want many people to be included in the digital economy and the way they access that kind of processing of data and reach out to those solutions, we must have as many people as possible be able to afford. And that has worked well in this country. Over time, smartphones are getting more and more affordable, and I believe the cost of production from the people who are doing it have also learned something. For you to sell to scale, you must make it affordable. A few years ago, to get a smartphone, you thought of 25,000 shillings and above. But today, people get that at less than 10,000. The difference could be how long is useful to you, but actually you have access to it. So the rural economy, the low-income economy requires affordability on the infrastructure, electricity and the gadget. Education is a plus. We have it everywhere in this country. All right, and you can continue sending in your feedback. We're seeing a lot of great feedback that is coming in from our online audience who are following this conversation. And just to remind you that if you have any questions, let's maintain it and let's retain it within the confines of this conversation, which is innovative financing solution for MSMEs and opportunities and challenges therein. So, George, I want you. Let's speak about Kesonia. This is yet another big conversation within the banking industry. And the question that comes to mind is, how can banks then use Kesonia to broaden their loan book or their loan portfolio and ensure that a lot more SMEs are brought into the formal financial sector without necessarily elevating their risk? It's a good concept. Kenya Bank Association and the banks that are members have worked very hard with the regulator to come to a point that is implementable in the next few months. A number of banks will be on that platform in pricing of that. How to use it basically is rewarding those who are good borrowers or those who are not borrowers. They are new, but you can assess their entry at the right level of risk. Assessing risk at the right level is very important for consistency and growth. So feedback that we are getting from different banks that are trying to implement that, we require to invest because the Kesonia rate changes every other day. There are rules that require that you notify customers when you change their pricing. So there's a mismatch in practicality. If your rate is changing every week, yet I'm supposed to give you 1 month notice. It can't work. So we need to have a system that automates how that communication is sent and also shortens the waiting time for the notice.
Yeah.
Granted that the changes are granular, but the law says you must notify for those kind of changes. So my hunch is that when we get to doing this properly, we'll be assessing people at the right entry. So the people who are not included will walk in at the right level of risk assessment. It's not necessarily that someone who has never borrowed is a high risk when they come.
Yeah.
It's not necessarily true. So getting people at the right level when they enter is a good thing. And many Kenyans diligently want to pay for their obligations. People don't just default intentionally. They default because sometimes they get their own plans wrong. If their plans are wrong, we should stop them at their plans. Look at this and this before we go to the next step. But if you pass a wrong plan to the point of funding it, the wrong plan will not be implemented even with a genius.
Okay, so back to that conversation that I had mentioned. Yes. I had mentioned a bit earlier, which is supply chain financing and anchor of taker models. Do you think these models can help reduce MSME liquidity gaps?
It does help. Supply chain financing does help because there's some at the top of the chain, some at the bottom of the range of the chain. If they have a contract that speaks to each other, that contract basically cushions someone in between. For example, if you are harvesting beans and you want to sell beans to another location and your value addition is minimal, that is just packaging. I'm doing nothing. I'm just drying and packaging. So someone has got the contract of just providing packages. And I know that I'm to provide packaging for 10 tons, which will be put in 5 kg packages to move from Kiambu to Machakos. So that buyer and this seller cushions this person in between whose work is to offer packaging. In fact, they could even give them an advance payment. Come for money, buy packages, and let's do this, and the balance will be paid when they reach the other end. Mm-hmm. So the originator and the receiver cushions people in between. Just a basic example how supply chain financing could basically be put into work and reduce the stress for liquidity. Otherwise, this guy in between for packaging would be looking for money to produce those packaging or import them.
Okay, so for an SME who's following this conversation and thinking, how do I de-risk my operation? What do they need to do?
De-risk your operation, first of all, by keeping your data well, and then have a business plan of what you want to achieve. Don't look at the good start, but you don't look at the end, how it might look like. Get advice for people who have been doing the same thing, and invest time in attending meetings, conferences where those subjects are being discussed. Do not be so much locked into your shop that every time you walk out, you think you are losing. Whatever you think you're protecting by not going out might be so huge that you can't compare with investing half a day to get lessons, to get learning, to get consultancy. And sometimes if it matters most, invest. Pay for some experienced person who has the skills that you don't have. Work together as a team. Do not necessarily say, I can't hire an accountant, I can't hire an HR manager. Work in a team, because these people have association. In many towns in this Kenya, people doing similar businesses have their own association. They could share resources. And those resources they are sharing are not objecting to it. I know people will be willing to do accountancy services, bookkeeping for 3 or 4 companies. So they must learn to work together, and they must learn to invest in technology and also in time to learn.
Okay. And so, George, when we started this conversation, one of the things that you touched on is the aspect of partnership. So for a lot of SMEs, what kind of partnerships are good for my business? When should I get into this partnership?
Again, it depends on what we're doing. You could be an SME, you're trading. So your partnership with your supplier, who could give you a credit days or could top up your purchases by some additional portion that you've not paid for. If you're in production, you need your raw material partnership or you need your off-taker partnership so that they commit in a medium term that you can predict. If I'm producing something that I have an off-taker and I've got guidelines of the quantities they need, the quality they need, it gives me confidence to talk to my supplier of raw materials and also possibly negotiate price better because I'm not doing it for the purpose of gambling, waiting. Let me give you an example of a furniture workshop. If you're producing beds and you know there's order for 100 beds, it gives you leverage to go and buy timber with some certainty of how much you need and when you'll pay. If the person selling timber sees your contract, I'm supplying this beds to this hospital, for example, they are more confident to verify and say, I can allow you to take this stock without paying for it in full because I know where you're going to end with it. As opposed to someone who is just buying from their own reserves, then parades them on the roadside, hoping that people will be passing and stopping and buying. Those are two different models, but they all apply in this country. I'm not saying you do one and leave one. Even the people with large orders still make some random production because you have the workforce that can be idle and you must pay them. So the workforce must be seen to be producing or produce, and you take a chance on the other part of the end of the chain of selling. Maybe that now makes you go out to look for market.
Okay. Yes. And speaking about opportunities for SMEs, one of the questions that we tend to struggle with, and especially when you speak to business and young entrepreneurs, is a question around diversity and diversifying my products. So you'll find someone who's running a business, but they want to diversify. So the question that I want you to help them understand is when should I diversify? When should I say, okay, I've had business A for a period of 5 years. Now it is time for me to look at another business in line with this business. And must it align, or can I start something completely different?
Diversification is naturally a safety strategy. And when you want to diversify, possibly you must identify the need of the market you want to supply. Many times people who are doing different businesses, same location, and they get out to diversify. Then you find 20 people who are doing different businesses, and their diversification is one business. That's not clever diversification. You're running a pharmacy, you're running a hardware, you're running a restaurant, someone is running some kind of shop. But when they all go to diversify because they've gone to a workshop that talk about diversification, they all come back in the same street and all open M-Pesa shop, all of them. So they're converging into one area of diversification. They are stretching the market need. So diversification time is that I'm comfortable with what I'm doing. I can spare more resources without starving this business, and there's opportunity where I'm diversifying. I should know whether I'm diversifying long-term, medium-term, and SMEs also love opportunistic diversification. This is not the business I do, but I'm told it's giving a good money in the short run. So they all go there. Your diversification strategy should define whether you are there long-term or you're not there long-term. I love the businesses that go out and say, I've done this for some time, I'm stable. I'm processing timber, and I'm stable. I get reliable customers. They come and do this. I like giving that example. And then I say, I want to diversify by opening a furniture shop. They know they produce, and they know they can have idle time to process for themselves. If you process for yourself, what do you do with it? You produce the next item. So this guy goes and opens their furniture workshop, for example. Someone who is selling grain in bulk, and they are able to sustain that kind of business. Then they say, now I want to do milling. They're basically in the same product, but they're diversifying. Now I want to do milling. Because they say, I can sell, I can restock mine at a scale, and then get discount and mill at a good cost of production. So it must not necessarily be very far from what you're doing, but there's nothing stopping you from doing it away from what you're doing. It doesn't have to be location restricted. You can be in Kitui and your diversification is in Limuru. Depending on what opportunity you've gotten there, because you have resources to deploy, the skills you want, and the governance that works for you. Because you stop being in two different places at the same time. You need to rely on people.
Okay. Now, one of the things, again, that we have seen, particularly within the Kenyan market, is the fact that now with easy access to capital, whether it's on digital lending or digital or mobile lending platform, a lot of SMEs are accessing capital from that. And I just want you to help them understand what is the risk in doing that, and why should I rely on formal financial institutions to get credit?
So there's a big risk in that, and there's a big advantage in that. The ease of access to credit, whether digital or conventional, is a good thing. But the problem is many times that easy access to capital underfunds your ambition. So look at the mobile apps that lend.
Yeah.
For people who want to start small businesses, they've gone to 5 of them. It's just a matter of time when they start defaulting on 3 of them. Then they find themselves in CRB, listed. Then the moment you want to scale to another level, they don't list the other side. So ease of access does not necessarily mean that you should run for them. Check if that access level will fund your need. If you're looking for $500,000 to start a small business, and NAP is giving you 80,000, another one is giving you 50,000, of course, the risk when they have assessed your limits, they've not shared data.
Yeah.
So if you access this money in a short period of time, none of them have seen your bad side, the other side. So in 1 week, you can access all of them in parallel.
Mm-hmm.
Then you get stuck there because one of them eventually will list you as a bad person.
Yeah.
So access must define sufficiency, must define that you have adequately what you need. Again, access, ease of it could be counterproductive if it provides you overfunding. So sometimes you take more than you need. Mm-hmm. And taking more than you need provides you the space for being either lose focus and spend it where it's not going to come back.
Yeah.
So it cuts both ways, but many times it's underfunding. Overfunding is not common, but also a risky space to find yourself in.
All right, when you look at SMEs financing, again, what are some of the opportunities that you feel our financial institutions, and particularly banks, are not tapping into enough?
Slow to change. The SMEs are changing very fast. The conventional banking sticks in one spot for too long. So you have your assessors who are used to a certain pattern of businesses, and their data point references become biased. Whereas these new SMEs, new concepts that have changed are not captured in the procedure, the process, the database, and the experiences we have. So the balance between how fast do we change, how long do we stay conservative, is an opportunity loss for institutions of finance, is also the frustration for new businesses. There are businesses that 10 years ago were the in thing to do, and there are businesses that now did not exist 10 years ago, but still we look at them in a very hesitant manner because we don't have history of it.
Yeah.
Relying on history alone does not necessarily define a good borrower or a good credit risk. Is having that foresight that I mentioned, you must have predictive sense of your analysis, not necessarily decision making. Decision making will fix you. We've given to these 7 guys this loan, 4 of them have defaulted. So you've used that data to make a decision, which is okay. But you haven't used the predictive nature that there's a new technology of doing what these guys defaulted.
Yeah.
7 people who are borrowing money to build their houses in the suburbs of Nairobi for residents, not for rental.
Yeah.
Then 4 of them failed. Then there's new technology you're building that requires less money and quicker time to do it, less fatigue and easy supervision. That should come into play. Is there new technology in doing what other people failed? That now gives the predictive edge of making a decision. New technology has come into space. All
right, so when you think as an SME, in terms of assessing the kind of solution that I want for my business, what are some of the key things that I need to look at to say that this would be the perfect fit? Because when you look at different financial institutions, they have different products all targeted at SMEs. So how do I go around picking and saying that this is the one that then will be able to meet all my needs?
Take one that gives you flexible repayment. Take that solution that gives you room to renegotiate if there's need. And most importantly, have your plan understood with your lender. For many years, banks never used to invest in agriculture production. Banks were investing in agriculture processing.
Yeah.
You go fight your wars with your farm, produce. Now you want to process, we can see the sacks, we can see the cartons, we'll fund you to buy the equipment. But banks were not investing in putting seeds in the ground to rot, then hope they'll germinate and grow in 6-7 months and you harvest. So it was a question of your plan being understood. And what happened? Money was expected to come back the first 2 months of lending. Your harvest will take time. Bananas, avocados, maize will take time. But banks have since understood. If I'm giving you money to plant certain crop, I should not expect you to repay me before the crop is mature and is sellable, if that was the source of repayment.
Yeah.
So that kind of understanding is now emerging. Even if I'm producing something, I should be able to define how long it takes me and how long it takes to go to the market. So I need a buffer of when I give it to you and when I ask you to pay back.
Okay. Yeah. So, George, I just want to tap into your experience in the region.
Yes.
And I want you to help our SMEs here in Kenya. What is it that successful SME businesses are doing, whether it's in the Kenyan market or in other markets that you've been able to see, that a lot of those SMEs that struggle are not doing? And what do they need? What lessons can they pick going forward, even as we wrap up this conversation?
A lot of successful SMEs in the region and elsewhere that I've observed in Southeast Asia, they don't compete unnecessarily. They collaborate more. If you're doing a particular kind of business, I'm selling grain, you're selling grain.
Yeah.
First of all, there's a default that you are my competitor. But there's more value to look at you as my collaborator. What are our challenges? How can we address it? Yeah. How can we leverage on scale so that we negotiate better? How can we share services? You find people who are selling produce in markets in various towns, everybody's hiring their own transport, and they're not optimally using the van or the lorry, whereas they could put all those in one lorry and come. I love the farmers of potatoes in Kinangop when they're selling to Nairobi. Yeah. They pull into one lorry until it's full, not everybody having their own transport, for example. So the person doing a similar thing to what you're doing is your collaborator, number one. And then using that, you can go to your associations of the business and change policy, influence patterns of how things are done. Yeah. You could even grow bigger to then go and change the tax regime. I've seen this in Rwanda many times. The business associations is like the thing to go to. Before someone starts a business, they go and inquire which associations influence this kind of business I want to join. So they make inquiry. If I come in, what is my benefit? Of course, there'll be subscription. There'll be access to lessons, there'll be access to knowledge, and there'll be leverage to negotiate with the municipalities, the governments, where the markets could be. So working together is their first strength as MSMEs. Then you can influence how you're governed, and you can also control how you are pushed. You know, when there's a massive default on certain sector to servicing debt in banks, everybody has their own problems if you're alone. But if you're together, you can come collectively and say, this market space has changed this way. So we are asking you to understand us in this manner. And everybody retreats and say, let's have a conversation. As opposed to going to list everybody, let's give these guys a blanket amnesty and restructure for all of them. And that drives the product innovation direction.
Okay. Now, just in closing, even as you prepare your closing remarks, I want you to speak to Street Smart. This is, I believe, is a handle for one of the audience who's following this conversation, who's asking, could you kindly comment about your Islamic banking in line with the topic?
Islamic banking in line with this topic is that is a concept that requires that when we lend to those customers who prescribe to Sharia banking, there are certain concepts that we don't involve. We'll not talk of interest, we'll talk of the profit, and we'll talk of the profit sharing. We'll not charge property for the Sharia banking in the name of the people who are borrowing, then charge it to the interest of the bank. If you're getting a mortgage, for example, is registered in the proportion of your contribution. If the bank is giving you 80% and you're contributing 20%, the first registration is 80-20 shareholding of that property. Is profit sharing or loss sharing? So as you continue funding it, you continue buying the shares back. And whatever could have been factored as the gain to the bank is a profit, is already factored into that repayment. We have a fully fledged division in National Bank of Kenya that deals with Islamic banking, with staff who are experts in that area. And they can take you through the products, they can take you through the processes, and that is available mainly in our Kenyatta Avenue branch, but also available in any other branch. You can find those expertise and services. So Islamic banking, SME, and conventional banking, they have a space to coexist, and they coexist in our bank for that reason.
All right. Any closing remarks as we wrap up?
Oh, my closing remark is that this conversation is not sufficient for just one sitting. This conversation will depend on how many times we do it, different people, different fora.
Yeah.
And I look forward to a time that people will not be looking at SME as a place that you go because you fail to find what to do elsewhere.
Yeah.
Previously, banking life, people would come for business money, and one of their drivers was that I looked for something else to do I didn't find, so I started a business. Business is not for people who fail to get what to do. It's for people who want to do business.
Yeah.
And when you get that with that mindset, that kind of an attitude, your success is elevated. So I would like this also not to be an exclusion discussion. It should involve everybody.
Yeah.
Some people start business when they're so young, 16, 17, 18. They have a sense of trade, they have a sense of business. Some people go to business because they were retrenched or they were retired. So that's not the reason to go to business. It would be possibly better off doing something else, and if you're trying to do business, you will struggle. I can't say you won't succeed, but your entry point should not be because you failed to get something else to do. Your entry point should be you've reset your mind and say, what I was doing is no longer there, or I've not started doing anything, but this is what I want to do.
Yeah.
So that gives you that energy to look long term.
Okay.
Thank you.
All right, thanks so much, George.
Thank you so much, Jimmy.
Mr. George Odhiambo is the Managing Director right here at the National Bank of Kenya. And that marks the very end of MyChat with the Bank CEO, this series of conversation that we have been bringing to you for the last 6 weeks. And I want to personally thank all of you who followed this conversation and been part of this conversation by sending in your comments, by sending in your questions, and a hearty congratulations to all the CEOs who've sat with me throughout this conversation, beginning right here with Mr. George Odhiambo. We had Mr. Batesh Shah. We also had Mr. Ralph Opara, Rafael Lekelol, Mary Mulili, and Jubril Adenji, beg your pardon, that is Jubril Adenji, who is the Managing Director, GT Bank here in Kenya. And again, our very hearty thank you to the Kenya Bankers Association for setting all this up and for having us have this conversation that are quite timely conversations, and we want to believe that you have learned something over the last couple of weeks. And of course, this is not the end. If you have any questions, you can send them our way, and we'll be getting in touch with the Kenya Bankers Association and directing you to the bank. If you have a specific question for a specific CEO that you have maybe listened to what they have had to say about the different topics that we've been speaking of the last couple of weeks, you can send in those questions at Kenya Bankers is where you can the handle that you can use on X. At Jim Carrier is where you can find me. Send in all your questions, all your comments, and all your feedbacks. Tell us what we need to do better, what we need to do more to address some of the issues that you have, to ensure that even as you continue doing your business, even as you continue doing your banking, you are a satisfied customer. Thank you for watching. My name is Jimmy Mbogo, and this has been a pleasure having you along this journey. Let's do this again sometime in the future.